JPMorgan just made more than $21 billion in profit in their most recent quarter. Goldman Sachs profits jumped 78% year over year, while Bank of America's trading business exploded higher 70%. Citigroup had its best quarter on record. Meanwhile, everyone's favorite BlackRock now manages more than $15 trillion in assets, the most in the company's history. According to the banks, the economy is booming. But here's the strange part. Just a few days ago on this channel, I was talking about General Mills, Pepsi, Campbell Soup, and Nike, and how all were reporting that consumers were getting more and more cautious, trading down, pulling back on spending, and getting picky about where every single dollar goes. So who's right? Which economy is real? Is the consumer actually struggling? Or is the economy stronger than most expect? Because right now, it kind of feels like Wall Street and Main Street are living in two completely different Americas. And I think the latest results by the big banks give us a clue as to what is happening. I think the economy policymakers have been trying to create over the last 3-4 years might have finally arrived. Inflation is high, but cooling. Growth remains positive. Businesses are still investing. The only sore spot is that interest rates remain elevated. Other than that, the economy is what everyone has been hoping for, a Goldilocks economy. Not too hot, not too cold, just right, especially if you're on Wall Street. And if that Goldilocks economy is actually happening, you need to know who the winners and losers will be, and more importantly, what it means for your portfolio. But first, welcome back to the Lunch Money Investing channel, where an ex-econ math nerd focuses on 1 to 2 topics every week that are moving the markets and break it down so that you can make more informed decisions for your portfolio and protect your lunch money. If that sounds like the kind of content that you're interested in, please go ahead and subscribe to this channel. I need more friends. All I do is read earnings reports. Anyways, let's go back to the main plot. For almost 3 years now, investors couldn't agree on what was coming. A hard landing, stagflation, permanently sticky inflation, rates finally breaking something in the economy. Everybody had their own idea, their own theory. Instead, something totally different might be happening. Inflation's falling faster than most expected. The labor market's holding up much more than anyone could anticipate. Business investment is picking up and deal making is roaring back. And somehow rates are still high enough where banks can make a fortune off traditional lending, but not so high that they break the economy. That's a weird combination. Normally, you don't get all of those at once. Usually something has to give. But based on what I just saw in this earnings season, maybe not. Because this wasn't one bank having a good quarter or one division doing better than expected. This was almost the entire financial system here in the US firing off on all cylinders all at the same time. And once we get through the numbers, you'll see why Wall Street is acting like it just found the cheat code to the economy. Let's start with the absolute legend, my friend and hero, Jamie Dimon. JPMorgan pulled in $57.3 billion of revenue in the quarter, up 27% year over year. Net income, that jumped 41% to $21.2 billion, blowing past analyst expectations. JPMorgan made more money in 3 months than most Fortune 500 companies make in an entire year. And the interesting part about the results was not necessarily the profit, but where all the money came from. The money came from lending, trading, and deal making. All business segments growing at record pace. Equity trading alone was up 86%. JPMorgan wasn't simply winning in one area of the business, it's winning in all of them, every segment firing on all cylinders. And these results aren't unique to JPMorgan. If you look at Bank of America, their profits grew 27% year over year, with trading revenue up 70% to a record $3.6 billion. Citigroup posted its best quarter in company history for its service business. There, they saw net income up 45% year over year. All of this happened while loan loss provisions decreased at all the major banks. People and businesses are still paying their bills. The economy might be slowing in some places, but it's not breaking. Then there's Goldman, which might have had the best quarter out of all of them. Profit was up 78% year over year, with M&A up 90% in the first half of the year. And Goldman alone advised on $1.2 trillion of announced deal flow, more than any other bank on earth. And then BlackRock. Revenue was up 31% and assets under management now sit at $15.3 trillion, the largest in the company's history. Markets are rising, investors are putting money to work. And through all of that, BlackRock is riding and capturing fees from every single dollar. Now, if this was just one company having a great quarter, you could write it off as good execution. But that's not what happened. That's not what we're seeing. Instead, every major bank beat. This is not a company story. And honestly, it's not even simply a banking story. It's an economic story. When the entire financial system fires on all cylinders at the exact same time for all the big players, that tells you something bigger is going on. So the next question is, why is this happening? Why now? How do you get record banking profits all while consumers are trading down at the grocery store and pulling back on things like Nike and Starbucks? Here's what actually resolves that contradiction. Banks don't make money simply because households are spending more freely at the grocery store or Target. Instead, banks make more money when money itself moves faster through the system, when it gets borrowed, traded, invested, or deployed at scale. A cautious consumer and a euphoric Wall Street can absolutely exist. They are not a contradiction. They are simply two different engines. One is about how confident a regular individual will spend their own paychecks. The other is about how confident capital moves through the system via deals, trading desks, loan books, and asset flows. Right now, the second engine is roaring, even while the first one is seemingly humming. That's not a contradiction. That's the split we've been tracking all year and dove into last week. And that split is looking more and more like a Goldilocks economy. Not too hot, not too cold. For banks, it might as well be the perfect operating environment, or at least as close as they can get to it. And there are really four things that got us where we are today. First, inflation is actually cooling. Headline prices actually fell 0.4% month over month, while core CPI came in flat. On a year-over-year basis, headline inflation increased 3.5%. Still above target, but at least it's not accelerating. And that's important for consumers, corporations, and more importantly, the Fed. Second, growth hasn't broken. Normally, inflation only falls because something broke in the economy, a recession, spending collapse. But we're not seeing that here. Business investment is strong. Hiring is holding up. Companies aren't acting like a recession is around the corner. Instead, they're acting like opportunities are everywhere, and that is showing up inside the banking and financial sectors broadly. Third, interest rates are still elevated. The 10-year is sitting around 4.5%. That's bad news if you want a mortgage, but great news if you're the bank and collecting the spread, which is exactly what we saw in the latest earnings reports. That's why net interest income climbed across the board for all the big players. And fourth, energy is finally behaving. Oil spiked past $110 a barrel at the beginning of the US-Iran conflict, but it has since settled down to around 80, still elevated, but nowhere near crisis territory. And cheaper energy acts like a tax cut on the whole economy, allowing companies to invest and banks to lend. So we have cooling inflation, intact growth, high interest rates, but not too high, and manageable energy. That's the Goldilocks economy. And if you're a bank, a trading desk, or an asset manager, that's about as close to perfect as it gets. And Wall Street doesn't just benefit from this Goldilocks economy. They benefit before other parts of the economy starts to see those benefits, which is what makes this so interesting and so bullish for the future. You see, banks are not just participants in the economy. They sit right in the middle of almost everything, a toll booth of sorts. When money starts to move fast anywhere in the economy, Wall Street feels it almost instantly. And right now, money is moving everywhere. We see it in lending with net interest income up huge at all the major players. We see it in trading with banks reporting that trading revenue is up 70 to 90% year over year. On top of those two, we saw investment banking take off, with Goldman Sachs alone advising on close to $1.2 trillion in deals in the first 6 months of the year. That's a massive amount of money. You put all of that together and you get a sector that benefits from basically every force in the economy all at once. And that's a rare thing. That's why many bank stocks are up massively over the last year. The market isn't rewarding those companies for one good quarter. It's repricing an entirely different environment. One where inflation cools down without a recession. One where rates stay high enough to keep profits flowing, but not so high that they break the economy. And one where capital keeps moving through the system. In other words, Wall Street might have just found the sweet spot. Now, obviously, that doesn't mean there aren't risks to the economy and to the stock market. There are always risks, especially in investing. We see that right now with the war in Iran and the US. We see that with US deficits that are rising, stock valuations that some have called frothy, and of course the Federal Reserve. They might become impatient and jack up rates in order to win the war against inflation. So where does that leave us? Honestly, I think this earnings season sent a real clear message. The economy markets have been hoping for over the last few years might have finally arrived, might have finally shown up. Now, that doesn't mean go dump your whole portfolio into banking stocks or financial services overall. You already know around here, I'm always thinking and talking about building a portfolio that is robust, that can survive a range of possible outcomes, not just the ones we're hoping for or the ones that we think will happen. So understanding who benefits from this environment and what can potentially derail the party is almost as important as being able to predict who the next winners are going to be. Because in the long term, investing isn't about predicting with certainty what's going to happen. It's about understanding and acknowledging the probabilities so that you can build your portfolio to benefit if what you think is going to happen actually happens. And at the same time, you don't lose your shirt if, for example, Goldman Sachs reports horrible earnings, which they didn't, right? Anyways, thanks for watching. If you found this information useful or entertaining, please smash that like button and consider subscribing to this channel. And as always, protect your lunch money.